Welcome everybody to the Friday video. Doug McKay, anti-wallstreetguy.com for the 8th of July 2011. The S&P cash today was much lower intraday, closed well off the lows on lower volume. So we closed at that 1343, 1344 level. The overall trend as of today is still long. What we're potentially looking at is the same thing we were looking at last week, which is a 1, 2, 3, 4, 5 pattern. 1 up, 2 is a corrective wave, 3 is a longer wave. The pullback today could possibly be the beginning of a 4th wave down and or fade or sideways. If this is the case, we do not want to see the 4th wave or this sideways move or down move or retracement break 1300. That would be the lowest we would want to see it go. That would be right where basically the 30-day moving average is and also support. We would definitely be concerned if we got below, let's say, 1318, which is where the 50-day moving average is. Ideally, in a perfect scenario, a retracement of this move over the last couple weeks to bring it down, let's say on some type of fib retracement to 1320 and support, or even the 50-day moving average around 1318 and then up through 1350 again would be perfect. I mean, that would be highly probable going through 2010, 2011 highs to new highs. All right. It could certainly all blow apart. I would expect to see some selling, more selling next week, possibly taking out this wick or the lows that we put in today. But again, if we go to 1320 and stop dropping, the market remains as long in terms of trend. 1300, we break that. I think we're going to test 1250, and then I believe it will be a series of lower highs and lower lows, finishing somewhere around 1228 or 1170, in that range. All right, but again, as of the close today, the overall trend still remains long. Now, if we look at this with the ETF, the SPY, we can actually see gaps where we cannot see gaps on the S&P cash. This is part of a post that went out yesterday to our 4-Minute Trader subscribers, and what we said there is in the next 3 trading days, meaning today, Friday, Monday, and or Tuesday of next week, we should see this gap get filled. It was obviously filled today with the poor jobs numbers and the overall poor economy, period. So that was filled today. We have a hard stop sitting quite a ways back, right around 130 and change. Obviously, we would be concerned if it broke 132, which is basically what we were looking at on the cash, which was 1320, 1380 in that level. So far, the market still looks healthy. The trend is long for 2 weeks in a row. Now, let's take a look. Let's pull up 2 more charts today. Let's pull up. This is the 10-year Treasury on a daily chart. You can see we had a big move down today, down 4.22%. Let's take a look at this on a weekly basis, thinking that interest rates could continue to go lower. There's quite a bit of space here between, let's say, 2.5 and where we closed today, just over 3. And it's quite possible that we would be filling this gap. We do kind of have a head and shoulders formation here on a weekly chart. Let's say this is the left shoulder here, the head here, the right shoulder here. The neckline is around 320. We traded up to that last week, and then obviously this week is down. So having said that, if we look at the exchange traded fund 7 to 10-year Treasury bond ETF, IEF, it looks like this. Let's pull this up on a daily basis, daily chart. It looks like IEF could possibly be going up to test the previous highs. Now, obviously it was down all last week as equities were rallying. This trade here, since we did get above the 30-day moving average and the blue line, the 50-day moving average, I would have my stop maybe 3-4 ticks below the low that was put in 1 week ago today on the 1st, and that low was 95.25, so maybe 95.21 if you want to play this bounce here in the IEF. All right. Again, we are above the 50-day moving average. But overall, be careful with what you're choosing now in terms of bonds, whether it be the corporates or things tied to treasuries or the high yield bonds. Okay, make sure you have your stops in place. But it looks like bonds, meaning rates, could be going lower for treasuries. All right, let's take a look at GLD. This is a very spotty chart in terms of gaps. A couple weeks ago when we gapped down during the day, right at the open, we left this gap, this open space open, and that was filled today. We did feel that at some point that gap would be filled. The problem is we've left plenty of gaps behind, not only today, but earlier in the week and then also last week. So this chart, we are trading above the 30-day moving average as of the last couple days. We are trading above the 50-day moving average as of the last couple days, and we're basically right at this downward sloping trend line. We're right at it. What we did say in the post here, if we got to close above 151 and change, you could get long GLD, but you'd want to have your stop basically under the 144 level. All right. So that's gold. Getting back to equities, the overall trend right now is long equities. Hopefully we're just looking at a fade here and holding the 50-day moving average around 1318 to 1320. The plus today for the bulls is obviously the trend is still long. We closed far off the lows for the day, and the sell-off was on lower volume. For the bears, the plus for the bears is there's no question the economy's in the toilet. Any way you cut it. We'll see what earnings do next week. We'll see what happens with Italy. So it should get interesting. And again, if we break down, we're going to have to get out. If we continue to break out, we'll move up our stop accordingly. All right, you guys, that's it. Thanks for checking in on the blog, listening to the radio show. Doug McKay, antiwallstreetguy.com for the 8th of July, 2011. Have a good weekend. We'll see you next week.